Hey folks, welcome to Barometer's Tuesday afternoon weekly webcast. I want to thank everybody for tuning in. As always, we like to kind of review what's going on in the world from a top-down perspective, how it relates to what we're doing in portfolios, what, if anything's changed over the course of the week, things we're thinking about, and things that are changing. And here we are now, the middle of October. We're in the heart of what is typically the toughest couple of weeks of the year, first 2 weeks of October. We managed to skate through September with positive results for markets. And there have been lots of things going right. And we don't want to jinx anything. We're coming up to an election, and it's going to be awfully tight, probably too tight to call. We're into some Fed easing, which is positive. And we got lots going on around the world, so lots to think about. So let's just jump right in. I've asked James Callahan to jump on today. We're going to talk a little bit toward the later part of the webcast, a little bit about tech and what's going on there, because lots of people are interested, and there's always things going on. So just off the top, we continue to be in this structural long-term bull market in equities that started in the US, which of course has been the leader over a long period of time. If we look at the last two bull markets, 80s and 90s, and the current bull market, marred by interruptions, but in between you get these 24 to 36-month runs, and we most recently made a new high after the 2022-23 bear market in January. So we're coming up on 10 months now, and the market's been marking its way higher. So I think that I would take almost any October where halfway through you're down 0.5%. I should knock on wood. But there are some things to be positive about, and we'll kind of talk them through as we go. There's the S&P. That's the low point in October of 22. We got up and out in the early part of January this year. For a little while, we were unable to make a new high after the high in July. Market pulled back about 10% toward the 200-day moving average, but you can see all the moving averages are working their way higher. We're above the 200-day, the 150-day, the 50-day, the 21-day, and the 8-day moving average. Market did ultimately make a new high in the month of September, and we've sort of chopped sideways here over the last couple of weeks, which frankly is pretty constructive. We pulled back and tested that breakout. When we think about breadth, we talk about this a lot in the early summer. A very small percentage of stocks were beating the market on the year. As we sit today, almost 70% of stocks are ahead of the market, ahead of the S&P 500. The equally weighted S&P, of course, made new highs in August and continued to make new highs, again, above all of the long-term and short-term moving averages. So pretty hard to be bearish when you're above all those moving averages. We're not terribly stretched, and we're working our way through the tough time of the year. NASDAQ 100 has lagged. It pulled back more. It pulled back 16% right to the 200-day. It has been unable to get back up into this channel that we were in earlier. However, again, pretty resilient. You can see moving averages slowly turning back higher here. So it looks so far like we've had a combination of a price correction and some time. July, August, September, October, 5 months. When we look at the rest of the world, it continues to be pretty constructive. Nikkei 225, broke out in 2022. It's had some great moves higher. One big leg, a consolidation phase, a second big leg, a consolidation phase. A little volatility, but very quickly back up in the range. My guess is we're more than likely to break out. Again, interesting, over the last 2 weeks, Warren Buffett raised more money in the Japanese bond market. I'm going to guess likely to buy additional positions in the Japanese stock market. He's been an active buyer over the last 2 years. India's continued to be very constructive. Taiwan, after consolidating 4 or 5 months, looks like it's ready to go higher. Argentina has been marking its way higher month by month, really since early part of 2023. And the All World Index has been outperforming US effectively since the lows in 2022. just recently through the trend line. And I think this is a very early stage shift. We've highlighted before that when global stocks start to perform well, they can outperform for a long time. This has been very muted to start with, so we'll see whether it picks up. When we look at emerging markets are at their weakest point on a relative basis versus US equities since 1969. And we know that when we get, significant underperformance for a long period of time, which we've seen over the last 15 years, it tends to turn. Now, a couple of weeks ago, we talked about the fact that we got this big blast off in Japanese stocks. This is the CSI 300 index in China. These are weekly bars. So 1, 2, 3 big bars higher. Now, pulled back. Everyone talks about how much it pulled back today. We've had this giant move to the high point, 40% off the lows in 3 weeks is just a remarkable number. However, this was the one market that really was sticky, and the PBOC and the policymakers brought out a combination of fiscal and monetary stimulus. Certainly, they are now easing. And, some of the pessimism is fading away. I think it is interesting that this has spurred the biggest thrust in breadth and thrust in liquidity coming into these markets in several years. So that's a positive as well. TSX Composite, as we've talked about, acts a lot like global markets, and after a long period of underperformance and then a tightening cycle, is looking beyond it. We're working our way higher. TSX actually, ahead of the equal weight S&P on the year and performing quite well, partly because of the sectors that make up the TSX. And that's also why some of the other global markets have been performing quite well. In fixed income world, rates continue to be sticky and higher. This 10-year yields, 1981 through 2020, we got up and through long-term trend. You can see long-term trends are turning higher here. Yields came down a little off the highs at 5%. They got as low as about 3.5%. We're back above 4%. It came out this week that Stanley Druckenmiller, significantly short the U.S. bond market with concerns about foreign demand for U.S. bonds and the huge amount of issuance that has to come from the Treasury this year to fund the deficit in the U.S. government. So for income investors in our world, we can go anywhere. Our income mandate is very tactical. We pick our spots. We can be in government bonds. We can be in corporate bonds. We can be in dividend-paying common shares. We can be in real estate investment trusts. When I look at the length of the drawdown in this bond market, this drawdown is very different than anything else we've seen since rates started to fall in the 1980s. It probably is pretty clear that something has changed. And even though bond prices have bounced after a 54% decline for a long-term treasury, it's about 11% off the lows. Not so much. And when we compare how dividend achievers, companies that have had a long history of strong dividends, are behaving relative to the aggregate bond index, very clearly the dividend payers are outperforming, and even more so dividend growth stocks outperforming versus bonds. So, we point out often that the last time we had a generational low in yields and they started to move higher, what worked through that period was stocks, and in particular dividend growth stocks. And that appears to be, the case currently, in our income strategy since middle of March in 23, income strategies up about 33% versus the bond market in Canada up 4% and the bond market in the US up 5%, actually ahead of the TSX and ahead of the equal weight S&P. And that's what happened in the 50s and 60s. Dividend growth led the market. And the nice thing about that is return, as I like to say, with a risk characteristic you can live with. Dividend growth tends to have, a half to 2/3 the volatility of the broad-based equity index with equity-like returns, as we're seeing. So we think this is early stages, and we think it can go on for a while. And when we move from income to commodity prices, commodity prices had their first leg higher when rates started to firm. We had when bond markets started to sell off. We've been through a tightening cycle. They've come out of that consolidation. We think that's pretty attractive and positive. I don't need to beat this dead horse, but we clearly believe that, like the bear market that ended in 2004 and gold broke out, the bear market that ended in 2020 and has now broken out is probably relatively early stages. Gold's up about 30% out of that consolidation. The 2000s, it was up about 345%. So very early stages here, and certainly early stages for the stocks as well. And you can see we only just recently started to see flows into the GLD ETF after money leaving gold all year long while it was firming. And that's what happens after a bear market. People don't trust any kind of increase. They tend to sell it first before they start to realize maybe this is sustainable, and money starts to flow in on a more sustainable basis. But I think that tells you something is shifting here. Copper prices, when China firmed up, broke out sharply from this rising moving average. We've seen a series of higher lows here. And again, we're coming out of a period of almost a decade where copper did nothing. And part of the reason is that there is demand growing from data centers. There is demand growing for utilities building out additional capacity. There is demand from electric vehicles. And because prices were low for a long time, there's really been very little that has been found, and even less that's been put into production. So we think that is probably not a bad place to look. So we don't have to be everywhere. We think that our job is to pick our spots, to try to recognize where something has changed and new money is starting to get put to work, and where there could be a long period of revaluation. After a 40-year bull market in bonds, maybe dividend growth can have its day over the next number of years as money gets frustrated with fixed income. So we got to recognize change. And then in the absence of something working, we have to have a willingness either to be on the sidelines out of certain sectors at certain points in time, or to, pick our spots. Sometimes it means we have cash in general in the portfolio. It doesn't happen to be now. But we think that our job isn't to look like the market. It's to find the productive areas of the market to take advantage of. And we use our breadth models to try to identify sectors and themes that have become under-owned and where breadth starts to improve. The percent of stocks performing well starts to expand. That tells you money is flowing in. And there's no bear markets that ever happen while breadth is expanding. Also, while breadth is expanding, it tends to be the market has a great ability to absorb bad news. When you're coming into an event and breadth has been improving, it means structurally the market is sound. On the other hand, when the index looks strong, but the number of stocks rallying starts to fade, that tells you that there's weakness underfoot. And maybe the market would be vulnerable to bad news. So we care coming into an election what the setup is. And in our portfolios, we think it is really important to find good securities. And our fundamental research team, James, who's on the call today, one of our core portfolio managers, Amit Joshi and Brian McNichol, work really hard at identifying companies that are good getting better. And I try to steer things towards the sectors that are seeing net inflows and the asset classes that have a constructive backdrop. And through doing this, we wind up constructing a portfolio of strong positions, but in parts of the market that people care about. So how do things look today? Well, in general, breadth is pretty strong and has been now for some time. In Canada, in the US, whether we're looking actually at the NASDAQ or the NYSE or the Amex exchange, all of them have shown an expanding number or percentage of stocks performing well. So buying is spreading to more and more issues. Globally, we're seeing the same thing. When we look at the short-term indicators of trend, percent of stocks trading above their 50-day or 10-week moving average, 5 days in a week, 10 weeks, 50 days, percent of stocks above the 50-day in Canada has been improving, and globally it pulled back a little bit this week in the US, about 5%, which was enough to turn this down. Although over the course of the week, the percent of stocks with positive weekly momentum or upward trajectory accelerated and moved higher, as did the percent of stocks making new highs versus new lows, as did the percent of stocks trading above their 150-day moving average. I highlighted last week, even though nobody got to see the charts because I forgot to push the button, that 80% of companies in the S&P are trading above their 200-day moving average. So it means it's a very broad-based rally. It means that should we have some difficult news from the election, or if we were to have some CPI data tomorrow comes out a little bit hotter than expected, market's in a pretty good place to absorb it. But it also means if you get good news, you should get a solid response in equity markets. So we're bullish equities. And I don't often say that in the middle of October. And I point out that the fourth quarter historically is the strongest quarter of the year once you get through the first couple of weeks of October. Okay, so let's talk a little bit about fundamentals. I think this is an interesting chart that was brought up this morning in our morning meeting, the percent of stocks with positive earnings per share growth. This is important. We're heading into earnings. The percent of stocks with year-over-year earnings growth, both have ticked higher here over the last couple of months. That means that from an earnings perspective, the breadth is expanding. When we look at the contributors to earnings, you can see why early in the year, the Magnificent Seven were the only game in town. That's where all the earnings growth was. But as we look out beyond here, you can see in light blue, the earnings coming from outside the Magnificent Seven is really starting to expand. So the rest of the companies in the index are really starting to contribute to the overall earnings per share. That helps us to understand why it is that maybe more and more stocks are participating. Let's talk leadership. We don't need to be everywhere. We got to focus on the things that are working and where we get good risk reward. And like a broad-based equity market, when a sector breaks out to new highs after many years of going nowhere, like the financials, we take note. And so we've talked about this, and it's probably repetitive. But over the last number of months, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months, financials are just steadily ticking their way higher. And we go out today basically at new 52-week highs for the sector. Now, on the short run picture, you can see that over the last, 4 weeks, 5 weeks, we've gone straight sideways, but with rising lows, that tends to be more and more buyers. We're coming into earnings, and we've got bank earnings coming up. And actually, I didn't ask earlier, but James, if you're close by, maybe you could just touch on what we're kind of looking for over the next week or so on the bank side. Are you on?
I am,
There he
Dave.
is.
Yep, I'm happy to. So we're looking from the banks. Obviously, we've got JP Morgan, Wells Fargo on Friday, and then we have the balance of them early next week. What we're watching for is color around plans for excess capital. So as a result of the changed goalposts on Basel III Endgame, a lot of the U.S. banks are carrying some excess capital, and it's not been clearly communicated the method by which they plan to return that to investors. So that's going to be one of the most important things watched this quarter. Besides that, a lot of the concerns have come out of the names. Commercial real estate exposure, that's less of a concern. It's been in the news for so long, and with rates moving a bit lower structurally, that helps commercial real estate. Those would be the main concerns. Capital return plans and the health of the consumer, I think, is pretty well determined at this point, and it should be pretty smooth sailing.
Yeah. So, we may see some news on net interest margins. We'll see. But again, my point is when we come into an earnings period with pretty solid breadth and trading near the highs, you can always get some bumpiness around the days that the companies report. And with the banks, you do tend to get a little bit of that. But we tend to look through them for a week or 10 days and see how they come out. So we'll get an opportunity to talk about them over the next couple of weeks. Of course, The insurance companies have been dynamite now for a couple of years. This is Fairfax share price. Fairfax made another new all-time high in the past week on Friday. This continues to be the biggest position in the firm, and it continues to just truck along. This is completely dependent on their ability to generate excess returns with their investment float versus what they pay out. Manulife, continues to move its way higher. We're trading today basically at a relative strength new high for the year, trading better than 83% of companies in the S&P. Some of the US property and casualty companies pulled back a little bit this week on concerns around another round of hurricanes coming through Florida. But in general, the insurance companies continue to do well. What I really care most about is this chart. This is the KCE ETF, which is made up of capital markets, banks, asset managers, and investment management providers. You would expect, if things are getting more difficult, for these to underperform. And again, we went out basically at all-time highs today. So coming into bank earnings, things shape up pretty well, and certainly the Canadian banks have had a great run sideways over the last 2 weeks, but trading better than 75% of companies in the S&P. So financials at a 25% weight in the portfolio continue to look pretty good. Industrials went out at a new high tonight. The equal weight ETF BIS and the market cap weighted XLI, they've been outperforming really since rates bottomed in 2020. This is a reflationary asset. Companies that have an ability to set price higher tomorrow if their costs go up today. Many companies with very tight supply of product, and we've talked about some of them over the last couple of years. Certainly defense stocks continue to perform well. Of all of the ETFs globally, the only one that made a relative strength new high yesterday was the aerospace and defense ETF. We talked a little bit about Embraer last week. We talked about Howmet Aerospace, which has been a really star performer in this group. And we talked a little bit about BWX last week, and this has just continued to truck higher. This is the supplier of small modular nuclear reactors. And again, this week, there was more discussion about restarts of nuclear power plants in the US. And it's almost daily that we're hearing about either recommissioning of existing nuclear power plants or the planning to build new ones in countries around the world as a source of baseload power. So, we continue to think we need to have some exposure here. In materials, 2 weeks ago, we made a new high. We pulled back a little bit over the last couple of weeks. Not such a big deal. Certainly the golds needed a little bit of a rest. So you can see relative strength basically sideways here, but trading better than 90% of companies in the S&P. That's Kinross. We talked about it. Alamos Gold. We've talked about Agnico Eagle. This is exactly what should happen when you get into a real move. You start to get a stair-step price behavior. And my guess is this little consolidation is probably getting close to done. And I just want to put this up again. This is the percent of investment assets that were focused in precious metals at the end of the biggest bull markets. This is where we are today. So to say that it's been a great performing asset for the year probably misses the point that most people aren't there. And I always am careful to say we're not gold bugs here, and we're not. But there is a time when risk reward is in your place, and it tends to be when you're into a liquidity cycle and rates are being cut and there still is some risk of inflation, and when there's some uncertainty, and certainly there's some of that out there as well. On energy, last week we talked about how energy has been consolidating in a range. This is the XEG, which is a broad-based index of Canadian energy producers. What I want to highlight this week is the ZEO, which is an equally weighted basket of the 10 largest energy companies in Canada. And this is breaking out. So this is roughly 10% weights in companies like Imperial Oil and Suncor. Imperial Oil, new high this week. It's up about 70% since it started to rally in the early part of 2023, and that's wonderful. We want to keep in mind what happened in the last bull market. It was up 950%. Again, this is a group that's not well loved. These 10 companies that we're talking about in the ZEO are all very large cap, long life asset companies. They all generate a lot of cash and they're all generating significant dividend growth. So it may wind up being boring, but we'll probably continue to talk about these as a great source of return of capital to shareholders through buybacks and dividend growth. On the service company side, we talked about Secure Energy a little bit over the last year. This company is in the service business and the energy patch, trading better than 85% of companies in the S&P. Had a great breakout in the past week. This was Friday, Monday, Tuesday. This tends to be, if it would trade sideways for a period, again, you're starting a new leg higher. And of course, PPL, which we've talked about, Pembina Pipelines, which is in the midstream services part of the business, transporting oil and gas, and again, nice strong relative strength. So these themes have been pretty persistent over the course of the year. This is the Pembina Pipelines long-term chart. We start to sound like a broken record because there's so many of these assets that took a long time trading in a range and have only recently started to perform. But this is why I always like to say our job is to try to identify change and get to a group early before everybody recognizes it, and then be there over the course of a move. If these companies have the kind of run that they tend to have once energy is in gear, it can go on for a while. Now, I got an updated version of this chart and I forgot to put it in. So this was the red, this current cycle up to March. So we can move out about another 6 months and a little higher. But you can see again, against the magnitude of previous cyclical rallies, we got a long way to go. Now, in the world of bonds, rates did move higher over the last couple of weeks. And look what happened to the 20-year Treasury bond. Pulled back quite substantially. And so you can expect that defensive assets that are high dividend payers with very little growth in dividend, pulled back a little too. Now, they didn't behave like the bonds. They didn't pull back to the same extent. But REITs did pull back to the 50-day moving average. Our preferred holding is Simon Property Group. It actually held in very, very well. And also the utilities did pull back a little, not much, just back to the 21-day moving average. Relative strength has stayed more or less in line. So we'll watch that, which is why we start with partial positions. Technology relative strength has been weak since June, but just trying to firm up a little bit. You can see the XLK ETF, which is large cap technology stocks, just trying to poke its head up. But if the group is trying to poke its head up, you want to watch what the leader is doing. Now, this is breadth, or the percent of stocks in the semiconductor sector that are performing well. When we're in a column of zeros, it means the percentage of stocks doing well has been falling, which it did all through July and August. And when it's in a column of X's, it means that slowly more and more of them are starting to perform well. So we started at 20% in October, and we're sitting here at 46%. So clearly some stocks are breaking out. Now, I thought I'd put up the chart of NVIDIA because this has been an important position for us over the last couple of years. And as most of you will know, we came out of the position worried that we were getting very extended above the moving average. And we were able to avoid, pretty big decline. But I've asked James to come back on because I think this is a great opportunity to talk about sort of how our strategy works from a selling discipline perspective and how we look at things once we're going forward.
Yeah, thanks, Dave. And it's good to have NVIDIA back in the equity portfolios. I'm happy to be back on the call now to talk about it. So we added it to some equity strategies yesterday. We don't own it everywhere right now. It's pretty fresh. So we're having some portfolio construction discussions and we're going to put it in the right places, but don't be surprised if clients on the call see it soon. So as you mentioned, we trimmed our position multiple times last year. multiple times this year because the stocks worked so well. But relevant to us exiting the position, we sold a third of it in July. We sold the rest of it in August. So our average sale price is about $111. And we got involved yesterday at around $120. And it's just been good and indicative of the process. Given some of the concerns fundamentally that we had with the name, they were having production issues with their new AI GPU chip, which was coming. They had an earnings report, which, you and I talked, Dave, before this call. If NVIDIA was to disappoint from a guidance perspective, they would have disappointed the last time they reported earnings. So we weren't involved at that point. And now we're through those two big overhangs. We've heard commentary from the company. We've heard commentary from partners and assemblers that indicate that they've moved past a lot of these production issues and are now all systems go. They moved through that earnings report and surprised to the upside, which was nice to see. Overnight we heard Han Hai, one of their assembly partners that actually assembles the chips into server products, they're expanding capacity. So they're adding capacity for assembly of 20,000 Blackwell servers. Blackwell is the new, the more cutting edge GPU. So they're adding capacity for assembly of 20,000 Blackwell servers in 2025 alone. So if you use the price point of the previous gen GPUs, which are about $35,000 per, the pricing is tough to learn. They keep that pretty closely guarded. That's about $70 billion of capacity. So it's a really big deal. Independently of that news, the time's probably right for us to get involved again. Chart's really firmed up. We've moved out of this wedge pattern. When we sold NVIDIA, we weren't trying to make the big call. By buying it back, we're also not trying to make the big call. We've just seen some big overhangs come off the name. It's one that we've liked over the last few years, and we've made some good money in it. And now we've just got a bit more conviction they're past some of the issues, and seems like a good addition.
It's James, it's always an important discussion to have. We believe in using stop losses. We really believe that you hold on to a stock as long as it continues to perform well, as long as fundamentally, the numbers continue to add up, and as long as there's continued acceleration in the numbers. We're not just looking for persistent growth, we're looking for accelerating growth. And then when technically something changes, either the sector gets into difficulty or the price behavior in the security breaks down from a price perspective, our job is to exit. We started seeing breakdown here when we broke the previous low here from June at 120. And then when we started breaking through the other moving averages. Now, I've always said it's okay to sell a winning position and take that gain and make sure we protect it. If the company continues to be one of the 20 or 30 best fundamental businesses that we can find, and if the sector can become more constructive, and you saw just recently breadth turned higher for semis, and then if technically the price picture can be repaired and coming out of this triangular period where the price range tightened and tightened and tightened and tightened and then eventually resolved higher, fine. Technically sound, fundamentally attractive in a group that we care about, in an asset class, equities that we like. It's okay to put a position back on at a higher price, having protect the gain in the first place. And this was just a great opportunity to kind of talk that through. So we talked about it first thing yesterday morning as we started to break out here. And my guess is we'll probably wind up adding it back sort of all over. Also interesting that the software group, which really underperformed since January of this year, as other more economically sensitive groups have performed well, traded once up to 88, second time up to 88, one time up 87, up to 88 again. Today broke out to new highs up 2%. This is made up of the large cap software companies. So to me, this also is important, and we added a little bit of exposure here. Now, things that we don't have big exposures in, healthcare continues to be sloppy. You have to pick your spots. Eli Lilly's been great, and we do have a position there, but relative strength has continued to be weak. Consumer, a huge sector in the US market, which has had very poor relative strength all year. Not like it's losing a lot of money. This is an equally weighted basket. But outside of home building, there hasn't been a lot to cheer about. So when we come down to it, when we take all the sectors and put them on a bell curve based on the percentage of stocks in each sector that are performing well, you can see down here at the right, we've got some sectors with a lot of stocks doing well. Down at the other end of the spectrum, some sectors with many fewer stocks doing well. Here's some consumer we can look at. Healthcare. Small letters means breadth is contracting. Large letters mean breadth is expanding. And green means strong relative strength versus the market. Yellow means neutral relative strength versus the market. And pink means weaker relative strength versus the market. So semis have moved up smartly. They've still got some relative strength improvement to see. But groups like precious metals, very, very strong. Banks, insurance companies. So we like to make sure we're watching the progression here. So what does it all mean? Financials continue to be our big overweight. It's been about this size of a position now for several months. Technology came up a little bit this week, maybe comes up a little bit more. We're still underweight, but because there are other things that we've been focused in that are less crowded, we think the risk reward that we have in the portfolio is pretty good. Big overweight in industrials, good sized overweight in energy, good sized overweight in materials, almost 3 times weight. A very low weight in healthcare, basically market weight in real estate and utilities, but it's a small weight overall in the portfolio as defensives, and a significant underweight consumer discretionary. And we watch for any sign that that changes. The nice thing is there's a bunch of themes that are working. And when we go back over the last, 10 months, portfolios are performing well. We're really happy. Income's up 19, equity's up 16. The new global fund is up 24%. Versus equal weight S&P at 13, and the bond market +2, and the global all world ex-US up 13 since middle of March in 2023 as things broadened out. The team's done a great job. Income up 33%, equity up 37%, and the global up 42. So we can't forget. We got an election going on. Yes, there are some conflict. There's conflict going on in the Middle East, which is really tough. We've got problems going on in Ukraine. But the number one factor for asset prices is liquidity, and we moved into a global liquidity cycle. When we look at economic surprises or the aggregate of economic data reports, in general, data is coming in now ahead of expectations since the middle of the year. So the index of economic surprise is moving higher. That's supportive. When we look at credit spreads, even the lowest quality corporate issuers are seeing the excess yield they have to offer come down relative to treasury bonds. In fact, the spread between BBB corporate bond yields and a treasury bill is about as low as it has been on record. So bond investors are not concerned about the risk of default. When we look at volatility, it continues to be sort of mid-range, and the market continues to be constructive. So we kind of like being in this position coming into, an event. We still got a couple of weeks of October we got to get through. We got to get through an election, and maybe that the election is so close that it takes longer than a day or two to call who the winner is. If it's the Republicans, probably mid-cap stocks get a bit of a boost. If it's the Democrats, probably the infrastructure providers, can have a bit of a boost. There's something, depending on who wins. But the net of it is the backdrop for the market's pretty constructive. So with that, if we got any questions, certainly happy to answer them. I encourage you guys to follow us on @Barometer CA on Twitter. We try and post in between. We're always happy to get questions beforehand. If you've got questions, let's take a look at. Last week I looked and there was something like 42 questions, and they all were saying, I can't see your screen. So gladly we're not in this situation today. Steve asked a question on energy, an opinion then other thing. Do you think the Trump administration have a real impact on crude oil prices? A lot of people think he will force companies to drill, baby, drill. This is not my view. Great question. In truth, it would be a really good idea for the US to refill the strategic oil reserve. They seem to have started, but they're a long way from that. US energy producers are in a different spot than the Canadian energy producers. US energy producers have to drill, baby, drill. If you're a shale oil producer, the life of the asset is relatively short unless you continue to stimulate it with fracking. In Canada, we have some much longer lived assets, 40, 50-year assets. And so we've preferred, the Canadian names. We don't, I think, own any US names. So Imperial and Suncor and CNQ, we think, are quite attractive and probably give us better risk reward. Next question. Do you believe the Canadian market can stay strong in the coming quarters? Do you believe it will relatively underperform? I do think that it will continue to outperform. We have sectors in the Canadian market that look as though they're coming out of multi-year bear markets. So energy and basic materials really important. The Canadian financial services companies are performing really well, and the Canadian industrial companies are performing well. We have a much smaller consumer sector, and that's an underperforming sector. And we have a much smaller healthcare sector, and that's been an underperforming sector. So the makeup of our market, I think, plays well to the type of market that we're in. Those assets that are working well tend to be reflationary assets, assets that do well when long-term rates slowly work their way higher. And I think yields are going to be sticky. Short rates can come down in the near term, but the longer-term rates are administered by the market, not the Fed or not the Bank of Canada. And these governments have a lot of debt, and there's not as much appetite for Canadian and US sovereign debt. So we think rates can stay relatively higher. We want to own things that can do well in a higher rate environment. As I said on many webcasts, last 40 years, the power was in the hands of the borrower. Falling rates helped them. And my guess is now power is in the hands of the lender. And that specifically references financial services companies, but other companies that generate lots of excess cash and don't need capital. Have the transports improved? Transports are mixed. The rails look like they're trying to improve. If China continues to improve, my guess is we probably see things firm up. Higher energy price is not great for them. And the airlines are not performing particularly well. Truckers, truckers are a mixed bunch. And opinion on GLD versus the equities, guessing we prefer the latter because earnings should be good. Yeah, one thing actually I was going to post today on Twitter. One of the signs of a true bull market is when the equities start to outperform the commodity itself. And it looks as though the silver and gold equities producers are starting to be more resilient than the metal itself. It should be that an equity producer, if they're a good operator, should get value for the excess cash flow they generate as prices go up, but they also should get value for the gold that they have in the ground, which they hold at a relatively low value and don't tend to mark up the asset as prices move higher. So ultimately, you should win on both sides, and we'll see whether that starts to happen or not. If there's some other questions that I haven't answered, happy to answer them offline. If you've got questions that you're too shy to ask, send them in to us, and we'll take a crack at them. And so hopefully the market stays sleepy over the next week or two. I'd be happy to see that in the face of, a risky time of year. But we'll continue to put one foot in front of the other. Thanks so much, everyone. Thanks for tuning in. Thanks, James.